After fearing that the Eurozone would remain in an endless recession, or worse, that the euro itself would cease to exist, investors' perception of the area seems to have changed following clear signs of improved momentum. A hard landing in China is now the #1 concern. Michael Strobaek, Global Chief Investment Officer at Credit Suisse, is with us to shed light on the situation. Michael, a year ago Mario Draghi settled markets when he vowed to do whatever it takes to save the euro. How would you characterise the situation in the Eurozone now?
Well, it is significantly better. What Draghi achieved was to put a backstop into fears that the Eurozone was about to collapse. And we since then saw peripheral bond spreads come down significantly, and that has calmed the situation and made it clear to investors that the Eurozone will move on. Growth has recently, or indicators for growth have recently positively surprised, and that shows the Eurozone is slowly recovering.
And while investors called the Eurozone the #1 risk a year ago, they now seem to be more concerned about a hard landing in China's economy. Will we see a further slowdown in growth in China?
Well, we don't think there will be a hard landing, but the growth in China is likely to slow marginally further. China has significant structural issues that are now coming to the forefront. Is in transition to a consumption-led economy, and the new government in China is very focused on making sure that the financial sector is not collapsing, but it is at the same time saying be careful with over-leverage, with overheating. So they have sharply intervened, as we saw recently, with putting up short-term rates, but no hard landing in China.
And the development of stock, bond and currency markets in recent weeks was further marked by central bank policy. What's your take on all of this?
Well, markets overreacted, as we said, when the central bank in the US initially indicated that they would taper or slow down the amount of purchases of bonds very fast. And markets overreacted because that was actually not what the Fed was intending to say. They intended to say we will pull down as better economic data comes in, but the first reaction was an overreaction, in particular in emerging markets. Now, markets, because the Fed has sort of pulled that communication somewhat back, has actually gone to new highs. And we feel that now the markets are pricing in almost the best of two worlds, good growth numbers, but also continued very positive QE.
Lastly, gold has reversed some of its losses. How do you see the development here?
Gold has stabilized because real interest rates have stabilized. The Fed, if you will, was actually becoming concerned about the rise in real interest rates, which was the reason why gold sold off. Now we're seeing stabilization, even coming down somewhat, and therefore gold has found its bottom. And we would be saying you should not be too bearish on gold at this stage. You should stay on a neutral allocation, and maybe will gold recover somewhat.
Thanks, Michael. For more information on market movements and global trends, check out News and Expertise on the Credit Suisse website.